Hello and welcome to Financial Intelligence. In this video, I want to share with you 7 lessons that I learned when purchasing my first rental income property. I believe that these tips are going to help you greatly if you are interested in investing in rental properties as well. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. Lesson number 1, setting a goal is critical. Before you start investing in real estate, it is critical to determine what your investment goals are. In general, real estate investors are interested in either creating cash flow or profiting from appreciation. If your goal is to make passive income on a monthly basis, then investing in properties with positive cash flow is the right choice for you. The second option is to invest for appreciation, which lets you build wealth by benefiting from the growth in the value of the property rather than collecting the monthly cash flow. When investing for cash flow, look for areas with strong rental rates and affordable investments. When investing for appreciation, look for areas with strong and growing demand for real estate. In general, there is a trade-off between the monthly cash flow and the potential for appreciation. This means that the areas where you can generate considerable cash flow have lower appreciation potential and vice versa. The main takeaway for me was that your real estate investment goal determines which real estate market in the country you should focus on. Lesson number 2, your agent matters a lot. Investing in rental properties by nature is a kind of a business that involves a lot of human-to-human interactions. An experienced agent can help you focus on superior investment properties as well as help you negotiate for better deals. For instance, the negotiation process can be stressful and complex. A lot of times, the party with more leverage or better negotiation skills gets the better side of the deal. Working with an experienced agent can make a huge difference. In many cases, a more experienced agent can save you a ton of money, sometimes even more than the commission you pay them. The main takeaway for me was that before getting involved with any kind of real estate investment, it is critical to find an experienced agent with high integrity who would protect my interests. Lesson number 3, real estate market is very inefficient. An efficient market is one where the price of an asset at any given time reflects all the available information. That is to say that purchase prices in an efficient market are going to be in the same ballpark as the true values of the assets. However, the real estate market is very inefficient, meaning that prices vary a lot depending on the perceived value of the property by sellers and buyers. That is because the way individuals perceive the value of a property is very subjective. Therefore, in many cases, there are huge disconnects between the actual value of the properties and their prices. You will find some properties which are listed at insanely high prices, and also some properties which are listed well below their actual value. The main takeaway for me was that it is essential to have a framework to objectively calculate the value of rental properties. Additionally, it is worth taking your time when you are looking for investment opportunities until you find an undervalued property to purchase. Lesson number 4, operating a rental property costs a lot. Many investors get excited when they see the rental income of investment properties, assuming that their net income, in other words, profit, is going to be close to that number. However, there are many costs associated with operating an income rental property, and they all eat into your profit margin as the owner. The landlords are responsible for paying for property taxes, insurance, maintenance, some utilities, and management fees. Furthermore, some of these cost components are considerably higher in certain locations compared to others. The main takeaway for me was to ensure that I was not underestimating the various operational costs when evaluating investment properties. Lesson number 5, do not get attached to a property. Purchasing a rental property is a lengthy process and it takes a while to find good properties. When you find a property you like, you tend to imagine yourself owning the property and enjoying the returns on your investment. When you repeat these kind of scenarios in your head enough times, you gradually develop some sort of attachment to the property. Being emotionally attached to a property could play against you during the negotiation process. You might end up bidding higher than you originally intended just to get the property you are interested in. The main takeaway for me was to stay objective when placing offers and stop my emotions from blurring my judgment. Lesson number 6, having a modeling framework is essential. Creating a model to estimate the expected return on your investment is essential because it allows you to compare different properties objectively. Since there are many moving parts when selecting an investment property, the process can easily get out of hand. The main goal is to move away from subjectively evaluating the properties and translate all factors into their equivalent dollar values. Your model should take the basic information about the property and some baseline assumptions and estimate the monthly cash flow and returns. Note that there's a trade-off between precision and efficiency when building models. The model should be detailed enough to paint an accurate financial picture, but it does not have to be super complex. The main takeaway for me was that having a model helps you compare various properties objectively. It also assists you in determining the maximum amount you should be willing to pay for a property based on your expected return. This is critical during the negotiation process because it prevents you from making offers that are too high to deliver your expected return. Learn how to shop for rates without hits to your credit score. Getting lower interest rates on your mortgage is super critical. However, shopping around for the best rates could result in multiple credit score inquiries, which would be detrimental for your credit score. When I started looking for lenders, I used to allow them to run the full background check on my credit history before getting back to me with their mortgage rates. However, later on, I learned that in many cases, you can actually provide the lender with your credit information and ask them to give you an unofficial quote. This way, you can quickly filter out lenders who would offer you higher rates and prevent unnecessary hits on your credit history. The main takeaway for me was to talk to as many lenders as possible, but not allow them to run my credit report before making sure that they were able to offer decent rates. I hope that you liked this video. If you have any recommendation or suggestion, add them in the comment section below. Don't forget to like this video and subscribe, and also hit the notification bell so that you won't miss any of my future videos. Thank you and take care.